Now, your question about performance in September, of course, September was one of the worst months for Asian currencies in over 10 years. And why did it happen? Well, several reasons. Firstly, we think that there is repatriation of capital, particularly by European banks, out of the region back to the euro. And maybe that explains that's one of the reasons why the euro has held up relatively well. A second reason why there's been flight out why Asian currencies fell is obviously Asian central banks let them fall. Now, why did Asian central banks let their currencies fall so fast? Well, I think they were taking a leaf out of the Swiss National Bank's book. Obviously, the most dramatic intervention this year probably was the intervention by the Swiss National Bank to try and stop the Swiss franc's seemingly relentless rise against all other currencies. And I must say the Swiss National Bank have been incredibly successful. I've just spent the last couple of days in Switzerland talking to investors, and I've asked them what's their view on the Swiss franc, and nobody knows. And so from the Swiss National Bank point of view, it's absolutely perfect. They've got the market exactly where they want them. No one's making any big decisions at the moment. Now, when the Swiss National Bank, in effect, devalued their currency, there was some talk that currencies like the Singapore dollar may take over that role. And there was certainly the beginnings of movements of a lot of money into Asian currencies. And I think September is a wake-up call to investors in Asian currencies, that it's not going to be a relentless rise of Asian currencies. Now, it's certainly our view that over the medium term, Asian currencies will appreciate. Our house view is that if you take a basket of Asian currencies against a basket of developed country currencies, the Asian basket should appreciate by 3 to 5% per annum over the next 3 to 5 years. So we're not calling for a one-off revaluation of the renminbi as some are, for example. We think it's going to be a slow and gradual appreciation. And therefore, of course, after an event like September, I guess if you've got 100 euros to invest, or $100, or 100 Swiss francs, or 100 pounds, and you're looking to invest in Asian currencies, should you invest now? Well, you're probably supposed to spend 20 or 25 of those euros now. Would I spend the whole 100? No, because it's certainly true that Asia in the short term is at the mercy of developments in the West. And of course, we're sitting here on a day when we're expecting large announcements out of Brussels, which will either please or disappoint the markets, and it's impossible to tell what's going to happen in the short term. But when you look at balance sheets, and Asia is overall a balance sheet story, when you look at the balance sheets of Asian countries, their balance of payment situation, their foreign exchange reserves, the fiscal situation in terms of debt to GDP, the health of the banking systems, the health of companies, the lack of leverage at the consumer level, and indeed the state of pensions. I mean, pensions are beginning to be introduced in Asia, but these are self-funded schemes. These are not liabilities of the government as they are in the West. On all these criteria, Asia is strong. Asia is far, far stronger than the West. So even if there is a dip in economic activity in Asia in the short term, as there will be if the West double dips, as in 2008, our view is that Asia can recover first and fastest. It is a risk, absolutely, and one of the problems that faces many people is that developments in China are relatively opaque. But let's not forget, I mean, China has only been a capitalistic nation for the last, let's say, 25 or 30 years. They're very much learning as they go along as well. Yes, there are big risks in China. You mentioned the real estate bubble. But of course, it is somewhat ironic that the world has actually been calling recently for China to slow down. China's been growing too fast. And when China was growing too fast, that was a risk for the world. And of course, now that China is slowing down, many of the scribblers in society that you read about in the financial press are saying, well, oh my goodness me, China's slowing down, therefore it's going to crash. And in terms of this hard landing versus soft landing, we're in the soft landing camp in China. We don't think that we go to a hard landing. Sure, there are bubbles in the economy that need to be lanced and sorted out. But just as upper end housing prices in China are going to fall, and I don't think we would disagree with that. At the same time, every province in China is going on an enormous house building campaign in terms of trying to build low-cost dwellings for the poorer section. So it's a little bit like focusing on the 1% versus the 99%. And of course, the other point to make about even the house prices for middle-class people in China, unlike in the United States, where most house purchases were financed with a mortgage, in China most people pay cash for their houses. So it's tempting to think that China could have a repeat of the United States. It could happen, but our view is that the authorities in China are in far greater control than the authorities are in the West. So your point is a fair one. The point is that today, when you're investing, nothing is risk-free. There is no free lunch. You have to do your homework. But when you do your homework, and when you do your sovereign risk analysis homework in particular, Asia looks in a very strong position. And our argument is that Asia should be a substantial part of any investor's portfolio, whether it's from a currency perspective, whether it's from a bond perspective or an equity perspective. I mean, according to Citibank, non-Japan Asia is already 25% of global GDP. It's going to be 50% of global GDP by 2050, according to Citibank. By 2050, the Chinese economy and the Indian economy will each be twice the size of the United States economy. So, the question I would put back to you and to your listeners and readers is, what do you think should be neutral to this part of the world? I think most people think about Asia in terms of asset allocations as a satellite. Asia is now core. Asia is the the center of our solar system in terms of economics and finance. Everything that happens today revolves around Asia. You think about emerging markets. I mean, what do people in Brazil and Argentina and Chile and South Africa and Australia and New Zealand do, and Russia for that matter? All they do is dig things out of the ground or harvest things that are growing on the ground and put them on a boat to China. Asia, in most people's minds, is a derivative of what's going on in the rest of the world. That thinking needs to change. It's the rest of the world now that is a derivative of what's happening in Asia. And that's the mindset of investors that needs to change.